Good morning and welcome to the Drilling and Production Outlook. I'm Richard Spears.
And I'm John Spears. Rich, glad to see you back in town.
I've been hiding out in the desert for much of the new year, but I'm back, baby.
That's right. You made the drive back from Houston just yesterday. I wish I could have done that drive, but the new car I bought was on that boat that caught fire and sank. So I've been sitting here in town working on the quarterly.
So
yes.
your car is somewhere in the Marianas Trench.
Sadly, yes, right.
We have I'm really glad that we have the drilling forecast today instead of a week ago or
I had a completely different forecast prepped last week.
Right, because our this forecast comes out every 3 months. So the last one was 1st of December, and it was like a forecaster's dream. Mm-hmm. You had slowly rising oil prices, you had slowly rising activity, and it was so predictable.
Yes, but if you remember in December, the Omicron variant was, emerging right after Thanksgiving, and so at that time, we were looking at sub $70 oil. Today it's 113.
Because it was going to crush demand.
Well, that was the word, right? Yeah. And before that, back in September, I go back and remember that the worries then was the upcoming Climate Outlook Conference and what that might do in terms of energy transition and capping or reducing long-term oil demand and so forth. So last 2 times and now 3 times, we've had a lot of news to digest and work into a forecast. So we've tried to do that for our crowd today.
It's why you have to do a forecast periodically. It's because if you could predict the future, then you would be locked into that future and you couldn't do anything about it. But the reality is all you can do is do the best job you can about factoring in all the known variables and recognize that some mule is going to jump in this system and bollocks everything up, and the future is going to change. And this is one of them. You have a forecast which is materially higher than it was
in December.
Well, 2 weeks ago even. And so you're going to present that right now. This is a 1-hour presentation. We're going to be done in an hour. But one of the things that I want to talk to you about at the end, because I'm going to let you have it, I'm going to leave.
Sure.
Is part of this is predicated upon the oil field service sector being able to respond to the demand signals. Is oil companies have the signal to ramp up. And they've always been able to count on the service sector ramping up right along with them. Yep. But the thing that's different now is that the capital markets are closed, the banks are closed to the service sector. Yeah. And that's going to constrain growth. So we'll talk about that, or you can roll it in.
We'll get to that because that has an impact on what we think the numbers will look like for the balance of this year. So, we'll get started.
So you're ready to go?
I'm ready to go.
All right, so I'm going to step out and I'll be back in. If you have questions, there's a chat box on the YouTube channel. Type your question into the chat box. I'll be monitoring it. Some of us will be monitoring that. And then I'll roll that in at the end.
Fine, sounds good.
Right,
will you pick the easiest ones or the best ones?
I will. I'll pick the ones I think you can answer.
Well, one of the things, in any forecast involves a lot of assumptions. And I think it's safe to say that one of the assumptions we've made for today anyway is that it's safe to assume that everybody watching the forecast has been following the news, and so I don't think I'm going to have to repeat what events have transpired over the past couple of weeks. I think we can go right into 4 or 5 key areas that we want to talk about today. One is, I'll sort of give you a little bit of a heads up here. Why have prices gone to $110 to $115 a barrel, up from $80 at the start of February? Why do we expect them to fall over the next 4 to 6 months? And then why then do we think they're going to stabilize around a $95 price level? That's our long-term forecast. And then there's a couple of long-term questions I think we want to consider, and folks have already sent in the questions on one of these points, which is this the start of a new super cycle for the oil and gas sector, the service sector anyway? What's the impact of the European Union trying to wean itself off of Russian oil and gas imports? What might that mean to places like the North Sea or so forth that have been neglected and abandoned for several years now? And finally, is this actually would this set off not just an activity supercycle, but an investment supercycle on the among the oil service sector. So a lot of that, and then we'll get to the activity forecast that I'm sure everybody is most interested in. So with that in mind, here we go. The events that have transpired in the Ukraine have occurred at a time when the oil market was beginning to tighten. The realization among traders and consumers and producers was that the market was tightening. It had been assumed when we met back in December, and before that, the assumption had been that come 2022, that the red line on this chart, which is production, would be comfortably above the demand line in blue, and that would mean that oil stocks inventories would rebuild, and that would cap the rise in prices and so forth. And in fact, those extra barrels that switched from a shortage to a surplus would be happening in the fourth quarter of 2021 and certainly in the first quarter of 2022. And what we see is, of course, that even before the events in Ukraine, that the market was not moving to a surplus, and in fact has been undersupplied, and it calls into real questions the assumptions behind whether or not the market can go to a surplus in the second half of this year. And so we look today then with the sanctions being placed on Russia, even though the sanctions themselves have not touched the sale of Russian oil and gas. It certainly affected the payment mechanism. And then there's a whole host of sanctions, primary sanctions on oligarchs and industry and companies and so forth, that call into question what is the provenance of Russian oil. So Russia, as we've all found out, exports about 7.5 million barrels a day of oil. About 2.5 million barrels a day is exported by pipeline. About 5 million barrels a day is exported via tankers. The destinations for that oil, about 40% of it goes to Europe. 20% or so, 1.5 million barrels a day, goes to China. Last year, about 10% came to the U.S. It shows up all over the globe, but short term anyway, because of the concerns about payments, because of the concern about tanker availability. If you load it on a tanker, will it actually be able to unload it on a port, since so many countries are banning Russian ships from docking in their ports? Concerns about obtaining insurance on this has meant that for now anyway, the whole question of Russian exports, Russian oil, has really grown quite toxic. And my guess would be that we have seen in the past week about the Russian exports have probably fallen on the order of about 5 million barrels a day. I think the stuff going to China and India is probably still in place, but there's a lot of oil that for now anyway hasn't found a home. And I think that's one of the reasons why we've seen prices jump up so much into this 110 plus range. It's because we have to increase prices in order to balance the market. It's handy at this point, I think, to remember that oil consumption anyway is very price inelastic. It doesn't change a lot even as prices begin to move. The economists of the world would tell us that price demand elasticity for oil is a negative 0.1, meaning that prices have to rise 10% to achieve a 1% drop in consumption. So if we think that Russian oil is that about maybe 5 million barrels a day right now is not finding a home in the marketplace, that's roughly 5% of global consumption. Global consumption, as you can see on the chart, is around 1 million barrels a day. So we've got to raise prices enough so that demand falls about 5%. So again, using that inelasticity number, it suggests to me that we'll see prices go up 40 or 50% from where they were before the Ukrainian situation took place. So $80 price roughly for WTI. Before that happened, a 40 or 50% increase would take you to $110 to $120. So it makes sense to me that the prices we're seeing in the marketplace infer that we're trying to adjust for about a 5 million barrel a day drop in supply. Now, I think the issue of the provenance of Russian oil and questions around how to do payments, where tankers can be found, where they can sail, and so forth, will gradually be solved. And in fact, if we look at the futures market, what you see is about a $15 a barrel drop from where the spot market is today to back to July. So 4 months out, you see a pretty substantial fall in futures prices. And I think that's telling us that these questions around readjustments to Russian oil flow will take place. And as that happens, as those questions are resolved, as some sanity is restored to the marketplace, we'll see prices drop back. Some, not back to where they were at an $80 a barrel price, but lower than what they are today. The hard part at this point, and what I don't have an answer for, and I think we'll all be watching for over the next 2 or 3 weeks, is how much of an absolute boycott there'll be on terms of buying oil from Russia. So it's one thing to not be buying today because you're not quite sure that you'll get paid for it, if it'll get delivered, and so forth. There's a whole other question about, will people just absolutely walk away and not want to do any business at all with Russia, even if they were allowed to do business? So it's sort of akin to the fact that in bar rooms across America, you're seeing Moscow mules being rebranded as Kiev mules, and so forth. So that's the question that I don't think anybody has an answer to. But it might be that several million barrels a day of Russian oil just gets left behind the pipe because there is no market for it, even though a payment process could take place and a delivery process could take place. So we'll see. But anyway, our long-term estimate for oil prices is that we'll see them stabilize around $95 a barrel for WTI, Brent being a few bucks higher than that over the balance of the year. And then it holds at those levels for another year or two beyond 2022, we think, just because the market's going to be very tight. Again, prior to last week, the discussion was all about how tight inventories are, and the fact that inventories at their very low level, crude and refined product inventories at their very low levels, were such that prices were going to be rising just because of worries about readjusting inventories. And I think the situation we're finding ourselves in today, which is that there's not a lot of spare production capacity in the hands of OPEC Plus, means that it's going to be very difficult for inventories to return to normal levels anytime soon. And really the only way to get that done is to dial back demand growth through higher prices. So this is one of the reasons why our oil price forecast now is substantially higher than what we had it back in December, when we were talking about a $70 to $75 a barrel price for crude this year. We're now $20, $25 a barrel higher than that. And it's all about the issue of, beyond the point of the Ukrainian situation, is just this very tight inventory level, which is going to drive prices and dampen demand growth. So we'll see how that goes. On the demand growth side, it's been estimated by our friends over at Rystad that the sanctions on the Russian economy will mean that oil demand in that nation will fall about 1 million barrels a day over the course of the year as these sanctions come in place. So that really doesn't affect oil trade, does it? Because Russian demand was being met by Russian oil. But we are beginning to see those kind of signs and worries that these high oil prices and disruptions to trade flows will cause economies to slip into recession, I think, are the other reason why the demand forecast that you saw on the first chart, which was as of early February, is probably going to be revised lower as the year unfolds. So we do have an estimate then of what, based on our drilling forecast that accompanies this, what will happen to crude oil production, because there's been a lot of discussion about returning to the days when we saw substantial oil demand growth, and whether or not that could take place, because we clearly have a group of operators here in the U.S., the publicly traded independents, I would say, Devon, EOG, ConocoPhillips falls in that category and so forth, who are holding fast, according to their public statements, about only moderately increasing demand growth. Last year was very interesting. We saw oil prices grow from about $40 a barrel at the start of 2021 to over $70 by the end of 21. And yet the capital spending plans by these publicly traded companies only changed by 1% over the course of the year, even though oil prices increased by 60-70%. In the past, we would have seen a commensurate increase in spending, but it's a new world for these publicly traded firms, and they held fast to their capital spending plans last year and returned excess cash to operators or to their investors, and we think that'll happen again this year. So there's a portion of the U.S. E&P community that is not going to chase prices higher, will realize some production growth, but modest amounts from where they stand going into the year. The biggest percentage growth, I think, then is going to come from the privates that have been aggressively adding to rig activity and completion activity over the past 12 months. We think that group will continue to drive activity going forward. And so over the course of this year, we think U.S. oil production will grow on the order of 1.4 million barrels a day and return back by the end of the year, return close to what it had peaked at in the latter days of 2019. So we're going to see much more oil being produced here in the U.S. It doesn't dial up immediately for reasons we'll talk about as we look at the activity numbers we think will occur, but it is happening, and it won't be enough to replace a tremendous amount of lost production from Russia, but it certainly will help balance the market, and it's a community we think will begin to deliver higher volumes going forward. So beyond this, what's happening on the gas side? Well, so much of U.S. gas production is in the form of associated gas from oil wells. So as we see U.S. oil production rise, we'll see an increase on the gas production numbers as well. We're looking at, again, exceeding the high point that we reached in the latter days of 2019, up on the order of about almost 8% this year if we've sussed out the numbers correctly in terms of how many wells are going to get fracked and at what initial productivity these wells will come in at, and how fast they'll decline and so forth. So a lot of moving parts when we put together a production forecast, but we do think the numbers are up and to the right pretty substantially over the balance of this year on both gas and oil production. And of course, one asks, well, where will all this gas go here in the U.S.? Because gas demand in the U.S. may only grow 1% to 2% this year. Reasonable growth for gas demand occurring in the residential, commercial, and industrial sectors, a drop in gas demand over in the power side, just simply because gas prices are rising, and there'll be some ability to substitute coal for cheaper gas, that happened last year. We think it's going to continue to happen this year. So domestic gas consumption in the U.S., we think up 1% to 2%. Clearly, most of the growth will take place on the export side. And when you hear about plans in Europe to find other sources for Russian gas, then I think that's the target of opportunity for the incremental numbers where we think will flow from the U.S. So in Europe, they import on the order of 32 BCF a day, of which 20 BCF a day comes by pipeline, much of that from Russia, and 12 BCF a day comes in the form of LNG. So there's probably on the order of 12 to 15 BCF a day of Russian gas that might be subject to being replaced by other sources. That can't all happen this year, but it's certainly a task that I think we'll begin to see steps taken to achieve. And so the U.S. is well positioned to supply a substantial portion of the gas that I think Europe's going to look to use in place of Russian supplies, so they began to wean themselves off of their extreme reliance on that particular source. So our gas price assumption along with that is that we'll see U.S. gas prices average something over $4.60 this year. That's up a full 10% plus from where it was last year. So again, a tight market. As with oil, inventories of natural gas are much lower than what they were a year ago. And so the combination of these low natural gas inventories and rising exports, we think, is going to be the key to keeping prices elevated over the course of 2022. And as the export picture continues to grow, looks pretty bright past 2022, I think that augurs for these higher prices for gas after this year. So we're just going to need to, again, it will be difficult, we think, to rebuild inventories. And so inventory situations will stay tight, and gas exports will continue to grow, we believe. And so that means that gas prices trade around a $4 to $5 range for an extended period. So what does this mean in terms of the response in activity? Because again, as I've said, we've had we have a community of E&P operators here, the publicly traded independents, who are all about capital discipline, and we think we'll stick to those numbers. Among international oil companies, this is a little bit more relevant to our international forecast, but since there are some internationals oil companies who work here domestically, those companies by and large have been under a lot of pressure by their investors to deal with energy transition issues. And so have the European majors have been backing out of oil and gas. The U.S.-based majors have been focusing on reducing their carbon footprint and so forth. So there's a group of operators as well among these multinational oil companies that I think are constrained about how much money they're going to put into E&P activity, upstream activities, exploration, field development, and so forth, even in the face of $90 or $100 oil prices. So that leaves us here in the U.S. Largely reliant, any activity growth I think is going to largely rely upon what privately held companies do. Now, good news is there's 2,000 of them, and in the bad days of 2020, when oil prices were struggling to get to $30 a barrel, very few of those independents had many rigs working, but they've come back strong in 2021. They added, as a group, they were adding rigs at about 3 times the rate of what these publicly traded brethren were doing, and that kind of trend, I think, is going to continue on into through the rest of this year. So they're not necessarily spending wildly and freely as they might have back in the glory days of 2017 and 18, but they've certainly come back strong, and that's what's pushing rig activity higher. So we think that on rig activity here in the U.S. will end up averaging close to 715, 720 rigs this year. That's up a full 50% over the numbers from last year. And as you can see from the chart, we end up with about 800 rigs working by the time we get to the end of this year. Now, Richard had talked about the supply or the capacity of the U.S. industry to reach these kind of numbers. And I think it's going to be a stretch, certainly going to be a challenge. Today, 90% of the rigs that work here in the U.S. are drilling horizontal wells. Today, that means that about 600 horizontal wells are being drilled, and now you have another 50 to 60 that are directional vertical wells, that kind of thing. For those 600 horizontal wells, the rig of choice is a super spec rig. That's the most efficient rig to use when you're drilling these horizontal wells with 5 to 10,000 foot laterals. So the fleet of super spec rigs here in the U.S. is approximately 700 today. Back in August, there were 450 of those 700 rigs under contract. We ended 2021 with about 500 of those 700 super spec rigs under contract. Today, 600 of those 700 rigs are under contract. And I would guess that the way things are going, that by the middle of this year, all of those rigs will be under contract, and by the end of this year, probably all of those rigs will be in the field. A bunch of the rigs that aren't working, the super spec rigs that aren't working today, probably haven't caught much work for the past couple of years. So there's a process to get these rigs ready to catch jobs in the field. But I think that we'll see that happen over the course of this year. That puts 700 super spec rigs to work. That we now have we would think there'd be another 100 rigs or so that are drilling vertical wells and directional wells and so forth. And the wild card, I guess, in the forecast is how many small privately held independents might decide to go off and drill shallow vertical wells. Those aren't high dollar items for the service industry, but they can materially add to the numbers of wells being drilled and the rig count eventually. So we're not seeing, in our numbers, we don't assume a huge recovery in that section of the market, but it could certainly take place. It's hard to gauge the native spirits of those smallest of operators drilling the shallowest of wells in places like Nowata County, Oklahoma, where a 2,000-foot well is a pretty deep well. So that's the issue, I think, that will come into play as operators think about what they want to do when they see oil prices at or near the current levels. But for now, anyway, we think that the industry will get to an 800 rig number by the end of the year, with the super spec rigs being the key component. Growth beyond that point in horizontal drilling, it then gets really tough because you're looking at the issue of new builds for those most efficient horizontal rigs. And new builds are several months to a year to get realized. The key components are long lead time items. Cat engines are 12 months or so. So there's a slow process beyond getting all the current rigs under contract. Expanding the fleet beyond that point takes a good long while. And it's one of the reasons why some of our numbers, if you look at the forecasts after this year, the growth numbers began to moderate, just because of this issue of capacity constraints. There are other capacity constraints we'll talk about with regard to frac crews in just a moment. Along with those 700 plus rigs, we think we'll see around 20,000 new wells being spudded in this year. So up again about 50%. We're assuming that the productivity of these drilling rigs, at least as you think about well spuds, will hold pretty steady. And that works out to a nice round number of 28 spuds per rig per year. There's some concern about that, the availability of casing and tubing. Nobody wants to start drilling a well without having the pipe on hand to get the well to get the well cased. So that may also act to slow some of the growth that we're expecting right now to take place in the second half of the year. Something we'll have to keep an eye on. But that's another choke point that the industry, I think, is going to have to deal with. Clearly, a lot of companies service firms are geared to what's happening on the completion side. That's really their primary focus. And so frac activity is key to the success, the health of those kind of companies. And so when we look at frac activity, the first thing, or one of the things we have to think about, besides just how many frac crews are available and working and so forth, is what's the productivity of those crews as measured by how many frac jobs they're completing in the course of a quarter. So here's a slide that looks at frac jobs per spread per quarter, going back to the start of 20 and then out through the end of this year. And as you can see, back in the dark days of 2020, when frac crew count dropped just so sharply, the denominator was collapsing, and so that ratio rose pretty dramatically. It went from a little over 10, I think it was about 11 frac jobs per crew in the early days of 2020, and that's what it had been in 2019 as well. And then we almost doubled that, and it's been coming down since. And the speculation as to why productivity, like measured this way, has been declining, I think, is linked to the fact that, as we all know, that the inventory of drilled but uncompleted wells has fallen pretty substantially. So you can be pretty efficient when you don't have to wait on a drilling rig to get a well TD'd. And in fact, all those wells are already sitting there just waiting to be fracked. And so you can schedule your work and get it done pretty efficiently without much wait time from one job to the next. And I think that's why that helped elevate these productivity numbers in 2020 and in the early days of 2021. But as we run down our DUC inventory, and now the frack activity is more tightly linked to how many rigs are running. And so now you begin to expose frack productivity to disruptions that might take place, delays that might be taking place in the drilling process. And I think that's why we have seen the numbers come down, particularly in the second half of last year. We hope that these productivity numbers will stabilize going forward. And that's certainly key to our forecast for how many frac jobs take place. But this is a key thing, I think, for us to be alert to. There's a whole nother issue beyond exposure to the drilling cycle that affects frac productivity, and that is the supply of the necessary components like frac sand. So we're beginning to hear about those problems now, and that could weigh on these kind of productivity numbers going forward. So we've talked about super spec rigs as a bottleneck. We've talked about drill pipe or casing and tubing as a bottleneck. We've got frac sand as a bottleneck. And all that is, I think, will impact how much, what the numbers are in terms of things like spuds and frac jobs. So our frac job count for 2022 has us totaling 11,650 frac jobs this year, up about 10%. The numbers dip in the fourth quarter of last year, first quarter of this year. It's a function of that productivity issue from the previous slide. As productivity stabilizes, then there's some recovery in frac activity. But again, as we look at these numbers, today we're running through Primary Vision, counting 290 frac crews at work. By the end of the year, in this forecast, we would be at 350 frac crews at work. And I got to tell you, our channel checks indicate a fair amount, or maybe a great amount of skepticism among the frac service guys as to whether they can grow from 290 to 350 frac spreads over the balance of this year. That's yet another choke point that I think will have an impact on how much work actually gets realized here in the U.S. in 2022. We're assuming that those kind of problems get solved, but it's not a given, and folks will have to work pretty hard to get to that point. And of course, prices on the service sector are going to rise in order to realize those kind of recovery numbers. I just want to talk about a little bit about what's happening among public oil companies. It's fascinating. I think, again, they're returning a lot of capital to their financiers. What's interesting to me is that the first 3 quarters of 2021, as you can see from that chart, the dark green segment of those bars was money in the form of retiring debt, and the orange portion was money in the form of stock buybacks. And so it was very much a debt retirement story through the 3rd quarter of last year. 4th quarter, based on the numbers that have turned in so far, says that the total money being returned is about the same, around $6 billion in the 4th quarter. But that time around, 2/3 of it went to shareholders in the form of stock buybacks. And so I think that the story going forward will be a continuation of this stock buyback piece. A lot of money by these publicly firms, again, capital discipline, limited production growth, and it'll be a remunerative time for the shareholders of those firms. Because I think any money, any revenues above that occur because commodity price, oil and gas prices were higher than forecast will probably end up back in the pockets of shareholders rather than service firms. Here's our estimate in terms of those well costs and how much they think they'll change. We do a quarterly survey here in the U.S. about well cost inflation, and we've been bumping up the numbers for 2022 as we've gone along. Now we think the numbers will probably end up looking at a 15% increase in overall well costs from the end of last year to the end of 2022. But again, there'll be a lot of components there are now beginning to rise more sharply than what they've done in the past, and so we might be light as to the quarter-to-quarter inflation rate by the time we see the end of 2022. What does this mean in terms of activity outside of the U.S.? Well, again, with Canada, we've bumped up our forecast a little bit. A lot of the Canadian activity is, Canadian activity is very seasonal. A lot of the yearly numbers for 2022 have already been already put to bed because of the amount of work that takes place in the first quarter up there. So our growth numbers for Canada are not as substantial as they are in the U.S. We think we'll see rig count up on the order of 22%, ending up with close to 159 rigs active across the year as a whole. 5,700 wells drilled, almost 55 million feet of hole drilled. So we're looking for a sharper recovery in the second half of 22 than what we had previously forecast, and that will bump up these numbers. Now, I don't believe that the constraints on the service sector in Canada are quite as severe as what we think they are here in the U.S. We could be wrong on that point. That's something we're going to have to watch very carefully. But for now, anyway, Q4 activity in 2022 looks much like the Q1 numbers back in 2020. So we think the capacity is there to handle the kind of spend and activity levels that we think will be taking place north of our border. Internationally, then, here's our numbers, our updated numbers. We think rig activity in the international sector as a whole will be up 12%, 807 active rigs, 8,300 wells drilled, 63 million plus feet of hole drilled. These numbers have been adjusted. We've taken out the 40 or so rigs that have been in the count in the Ukraine. We don't think those rigs will be appearing going forward. So that's a one-time adjustment which has lowered activity by about 40 rigs over the last 3 quarters of this year. And so even with that adjustment in place, we're looking at a 12% growth year over year in terms of active count. It's split up unevenly by region. We'll talk about that in a second. I think it's important to note that over the course of last year, that rig count, international rig count, rose about 17%. And we think that kind of underlying growth trend is going to remain in place for this year as well. And the only reason we're not ending up with a 17% growth in 2022 is a function of this loss of the rig count in the Ukraine. So still a double-digit return to growth, but numbers that aren't nearly as high as they were in the last days of 19 and the first part of 2020. And again, that's a function, much of that is a function of these international oil companies who have begun to cap their E&P spend due to investor worries about energy transition and whether or not it's a wise move to be adding to capacity and growing production when there may be when the demand curve might bend lower due to worries about climate change. So this will be fascinating to watch because I think longer term the issues around the Europe's diversification of its energy supplies may certainly have an impact as to drilling activity around the world as new sources of supply, both for oil and gas, are developed to achieve that end. Offshore rig activity, we think is up 14%, as you can see here. Again, a steady state kind of a recovery over the course of last year, and we think that extends into 2021. So we've got improvement both land and offshore in our international sector. And again, like I said, by region, we think there'll be a fair amount of variation. So Central and South America, up 26% we think this year. You can see the numbers, 170 plus active rigs, 2,300 wells and so forth. The interesting thing, the news item out of South America this past quarter has been plans down in Mexico for Pemex to halt its crude oil exports in 2 years' time, by 2024. And instead of exporting that crude and keeping it at home and refining it for sale domestically. So the Pemex's downstream sector has historically been very weak, and in fact they've been exporting crude and then importing refined products. And now the administration in Mexico City wants to change that, and but that comes at a high cost. So the question is whether or not Pemex will have the financial capacity to be able to support the investment they need to increase their refining capacity by the order of, I think, 400%, a substantial increase there. So that's going to cost a lot of money. The other question is one of profitability. Historically, Pemex's refining sector has not been profitable. It's lost the money. So they've made money in terms of crude exports, but not in a refined product sector. So that is going to be quite an adjustment taking place in that country, and that may have an important bearing as to how much activity is taking place down there over the next few years. I don't think it's going to be as foreign investor friendly as it has been. That's been clear for a while now. And I think those plans are going to continue to be challenged for foreign companies wanting to work in the upstream sector of Mexico. Europe, again, down sharply. Again, that's because Ukraine has been is in our European geographic market. So a rig count down to 63 active rigs and something like 600 new wells drilled. I think the interesting question there, and it won't play out in 2022, but more longer term, the question is, as Europe tries to diversify its supply, will it go back to its fields in the North Sea and try and increase production from those fields? This will particularly have a bearing on the UK sector. Norway has not seen a drop in output, certainly not like the Brits have, and so I think this question of diversification of supply sources may put more wind in the sails of the British sector that we haven't seen for quite some time. It'll be interesting to see if over the next 3 months or so we begin to hear plans to that end with regard to let's think of European production of oil and gas. Africa, another sector that's begun to recover very nicely, up 32% we think this year, 125 rigs, almost 1,000 new wells drilled. Some exciting news on the exploration side is taking place in Namibia. So quick, grab a map so you can find out where it is, just north of South Africa. The offshore drilling taking place by Shell and Total Energies has discovered some tremendous new supplies. So they're just in the exploration phase, but the question that comes to my mind is, will Namibia be the next Guyana? Guyana has so far, through Exxon and others, discovered 10 billion barrels of offshore oil. They think the Guyana offshore resource base could reach 20 billion barrels. There are plans in Guyana for 10 big production centers producing 1 million barrels of oil a day. So you began to see what kind of potential might exist in this Namibian play that is brand new and just come onto the stage. Mideast up 9% or so, stable kind of recovery that's taking place. Almost 270 rigs, 2,400 wells drilled. News just yesterday was the return of Iran to the global oil market. It's been producing about 700,000 barrels a day under the sanctions regime that the U.S. and others have put in place. If these sanctions get relieved, more Iranian oil will enter the market. How much is yet to be determined, but it could be 700,000, maybe 1.5 million, as much as 1.5 million barrels a day. Might go a long way to replacing any lost crude from Russia. The timing of that's unknown. The other great unknown is whether or not any foreign firms, which then might be allowed to invest in Iran, would actually step up and do that. The Iranians have lots of plans to develop fields, but they need a lot of dollars, and those dollars would have to come from Western firms. And the question is, would they do that given, again, the firms in question all are under pressure by investors to reduce their oil and gas exposure because of energy transition concerns. So the question in Iran, I think, is going to be fascinating as it plays out over the next 6-12 months. And then finally, Asia Pacific, that market there is, we think, up about 12%, 180 active rigs, 2,000 wells drilled. What's fascinating is that the multinationals who own fields in that neck of the world continue to sell their positions there. It's dropped basically in half if you look at it in terms of assets, 30% in 2015 to 15-16% this year. The ones who are buyers tend to be the state-owned companies in that market. So activity level is certainly activity, and who the operative question is changing hands in a pretty noticeable fashion in that part of the world. And then finally, we have China, Russia, and Central Asia. Russia, I think we know, is one where the Western majors are backing out. They're falling all over themselves to back out. Now the U.S. government is suspending exports of oilfield technology. We won't be doing business in Russia for a long time now. China, on the other hand, we think is up about 4%. They continue to make moves both in terms of unconventional oil and gas development and now carbon capture and storage to try and support EOR recovery efforts in some of their mature fields. So those will be interesting opportunities that might pop up from time to time. And Central Asia then is another one that is we think is poised to grow a little bit over the course of the year. It's a pretty opaque area to follow, but we think we'll see some improvement in that neck of the woods as well. So that's our look at activity. I'm going to let Richard step back in here and bring with him questions.
This is a fun forecast as opposed to the one that we had right after COVID hit.
No, yeah.
But, Schlumberger got it on the chin on Wall Street whenever investors realized that, well, if Exxon's pulling out, if Shell's pulling out, then, Schlumberger, they're going to lose all that business in the former Soviet Union. Or, no, sorry,
Russia.
Specifically Russia.
Yeah.
And so we had to look at it. Our colleague David Ott, who manages these things for us, he looked at it and he says, Schlumberger has less than 5% of their revenues comes from Russia, and it may be 3%.
Yeah.
When I look at your forecast, all the rest of Schlumberger's world is going to grow by 20%.
Oh yeah, yes, right. Yeah, there's it will more than offset any loss that comes from there, and I'm sure that Russian stuff is probably carries a higher profit piece, but still, from a revenue standpoint, it'll be swamped by any improved activity, particularly, as I said, as Europe tries to diversify its supply. Where's it going to go? It's going to be offshore sources, right?
Yep.
A lot of that's going to take place not in the U.S., but in outside the U.S., outside of North America, where Schlumberger and the bigger guys are very strong. So yeah, I think they'll come out smelling like a rose.
I would, if I sat on the board of directors of Schlumberger, I would telegraph to the investors that we hate losing Russia's business. But at the same time, I'd be sitting back there, rubbing my hands together, saying, "I'm so excited about the 20% growth I get everywhere else," because that's always really, really healthy.
Yeah.
So when I look at the forecast, it assumes that peace does not break out. But what if peace does break out before summer? Does that have any impact at all on this outlook for oil prices, for gas prices? Does the world financial sector and all the politicians say, yell ollie oxen free, you're forgiven, just go back to where you were, back in January, and
tanks go back across the border, the sanctions are lifted.
You bet. They apologize, they rebuild all the building.
Yeah.
Does it have any impact? Does it change any of this in the current year and in the future year? Because my guess is that it doesn't at all.
Probably not. I mean, I think the likelihood of that happening is right up there with the Ukrainians actually winning the war and driving them back. I just don't see a return to the status quo ante, as they say in the foreign affairs business. So, now if something like that were to happen, there would be some adjustment. And perhaps most importantly, it would be on the demand side, right? Because you think oil prices would fall back. Demand then, which has been growing 5% plus last year, was going to grow 2 to 3% this year. we might see those kind of numbers continue on into the future, and that would put a tremendous amount of pressure on the industry because there's just not a lot of spare barrels around. So even if peace were to break out, I'm not sure that the price forecast would change very much.
So one of the things that I'm dealing with, because I'm the one of the two of us who sits on boards, is that every company on whose board I sit right now is struggling to try to find growth capital, because these are all oil field service companies.
Yes.
The oil companies themselves kind of have solved that problem because they're generating
record
cash,
profits, yes,
and
returning
the banks
capital
are open.
like we saw. Yep.
But the service companies, the folks that actually have to go do the work, the banks are still, the capital markets are closed to them. The banks are closed to them for, hey, you want to borrow a little money for growth. So that does not exist. So, but in our
I think
forecast,
the banks are closed to them in the sense that they set letters of credit lines in place, in the bad days of 2020 and 2021, and those remain, but they haven't been increased, right?
Right.
So, so they've kind of maxed out what access they have to bank loan lending.
Yeah. Now this does not apply to Halliburton, Schlumberger, Baker Hughes, because they have it's different for the giant oil field service companies. Right. But for the other 10,000 or 20,000 oil field service companies, you have to work out of your positive cash flow. And growth has already been so strong prior to this $100 oil that the cash has gone into putting equipment back into the field.
So the credit lines that have been available have been maxed out to build up the working capital needed to handle 650 rigs.
Getting very
Where's
close.
it going to come from if you get to 800 rigs, right?
So part of your forecast, like with for example, with respect to frac jobs, the demand for the frac jobs is certainly there, and that's actually what you've got in the forecast. And in the olden days, when capital markets were open, debt was available, we knew that money would flow to the service sector to provide then the frac spreads, the frac crews that would be able to get this work done. Right. But there's serious constraints, and there's no change right now here in March of 2022.
Well, and just right alongside that is the labor question, right? Like, I mean,
gracious.
So there's real world problems. Where would the money come from to return idle equipment to the field and to make it job ready, as it were? And so there's, and you say, okay, well, banks might begin to rethink their position in terms of credit lines as they see $95 oil, right, or $100 oil. So there could be some of that, and probably will be as time goes by. But that's a slow go.
That doesn't get solved in March.
No, it doesn't. It doesn't. It might get solved by the end of the year, but it doesn't happen soon. Right? Yeah. Apart from that, then there's the question of, alternative capital sources. That's high cost debt, but we know it's out there, right? Yeah. And we know that. Yes.
I was in New York 2 weeks ago.
Yeah, there you go. Right.
Those guys are looking around, but again, they're not deploying capital yet.
No,
they're looking. They got a team together.
So we'll begin to see the bank side ease up. We'll begin to see alternative sources come in, and folks will service companies will bite the bullet and say, "Great, we'll pay that exorbitant interest rate, and because we need the capital, because we got the work we could do." We might see some customer financing where a service firm says, Mr. Operator, I'd love to go to work for you, but I need $2 million to refurb my gear.
Well, how about this? I need $37 million to get another frac spread out.
Yeah, right. So there is going to be, I think, some of that take place. It's again a tricky deal, but boy, oil companies might go for it because they don't want to release rigs, right? They don't want to release equipment. They want to be able to have the gear there when they want it there. So that may be a way for them. I mean, we've already begun to hear that some operators paying their drilling contractors on 5 days after the invoice gets submitted because they want that crew to stay to work for them. We don't want to lose that guy to my operator friend across the fence. So those are the kinds of things that I think will help rebuild the capacity of the service sector. But it's a day and night, 24/7 kind of work to get it done.
So you mentioned people. So this week I've talked to the well servicing contractors who have approximately 200 active well servicing rigs across America.
Well maintenance kind of stuff.
Yeah, well maintenance, but also well completion.
Okay, gotcha. Okay.
So of the 200 that are in the field,
Yeah.
Of these companies, guess how many incremental rigs have been able to? They've been
So
able
these
to
are
put
200 companies. These are
200 well servicing rigs.
Okay, gotcha.
It's a small
so
set
of those
companies.
guys, 200.
Guess what the incremental number of rigs they've been able to put to work since the first of the year? Not because demand's not there.
Is it, I bet it's not even single digit percentages.
How about this? One.
One rig.
So 200 well servicing rigs active.
I may have to
They've been
revise
able
my
to put
forecast.
201 in the field because the number of people quitting is equal to or greater than the number of people that they're able to hire.
Yeah, so all of the numbers we've just been talking about have been new wells and completions and so forth. And that's a well maintenance thing. But again, that's very important,
but it's
right?
well completion because get this. It takes 2 well servicing crews you have to shut one of them down to do the 24-hour operation for if one of your rigs gets a well completion.
Oh, I see. So
it's 24 hours a day. So you shut one of your well maintenance operations
pulling
down.
rods or whatever. And
you bet.
Bring those. Okay.
And so now I got 2 crews and working 12 and 12. And so well completions means well maintenance gets delayed.
Right. And so for those long lateral wells where a coiled tubing unit doesn't get the job done and you need a well service unit, that's where that really plays a role.
Or there's just some corkscrewy kind of wells that you need to have stick pipe to get that done.
Okay.
All right, here's one. We talk about the reduction of oil and gas coming out of Russia.
Yes.
But we can't forget that there's some really major manufacturers of electric submersible pumps that are in Russia that sell their pumps all over the planet.
Yep.
Those get stopped too. Drill bits, those get stopped. Pipe, that gets stopped. Mud motors, that gets stopped. So you've got this supply chain where the world's oil and gas industry relies on Russian-built equipment. That gets
for certain
stopped.
sectors. Yeah.
So it's not everything. But certain key components.
Yeah.
And you look at the ESP manufacturers. We're here in Tulsa. They're all around here.
Yeah.
Can the non-Russian ESP companies, which includes Chinese,
how fast might they do that? Yeah, right.
Yeah, so that's a pieces and parts issue.
Yeah, no, the oil field is just one of many supply chains, right? I mean, you think about Russia's position with regard to base metals and steel and things like that, and so there's a tremendous disruption coming in this. One of the things I read the other day was that Ukraine is the source of 70% of the neon that is used neon gas.
Not helium.
No,
neon.
Neon gas. It's used in the manufacture of semiconductors and things like that, right? So you've got all kinds of those issues that we're not even on the front end of those kind of questions.
Oh, here's one that's absolutely going to hammer the drilling side of the sector. Cobalt. And I don't know what percent of the world's cobalt comes out of Russia, but it's a bunch.
Yes.
Guess what product is used in every matrix PDC bit?
Right, which, again, those are the bits that are being used to drill horizontal wells.
You bet. You got two types of PDC bit. You got the steel body bits and you got these matrix bits.
Yeah.
Those use cobalt.
Yeah.
It's already hard to get. Now what happens?
Boy, because that probably means we're not going to build as many EVs as we're because they use cobalt, the battery section there, right? So,
my Tesla that I've been helping.
This all goes back to the question about commodity super cycles, right? Elevated prices, rising prices there, and you could certainly see where that is. I think early on, I talked about super cycles. Does this kick off the kind of investment in the oil service sector super cycle like we saw back in, 12, 13, 14, and then began to return back in 18?
Well, I argue
19.
that it started in 1999, and then you had a war that launched in 2001. Remember that?
Yeah, sure, right.
And you had the low point in 1999, and it extended all the way to.
Yeah, but the point is, will we see anything? What part of that might return, right? And
Are you in or out on super cycle?
Well, see, I think I think this time around, I think that oil prices will be high, but I think the investment in field development is going to be muted. I think that the world is working itself into a position where high prices are going to end up capping demand growth. And, right.
But that suggests that they've got some alternative
Yeah.
to that hydrocarbon.
Yeah.
And this, so I was asked this question the other day, so I'm going to throw it to you.
Yep.
Where was the where is it the most I don't know, where was the idea of ESG and hey, we need renewables instead of fossil fuels?
Yeah.
Where is the geographic mother heart of that?
Yeah, right. Europe began in Britain. Yeah, it's Europe, right?
And Germany was the biggest applier of we're going to go to renewables.
Yeah, right.
And so Europe is the heart of that.
Yes.
Did this war? And oh, by the way, the Russians blew up the Ukrainian nuclear power plant last night.
Well, they didn't blow it up, but they took. Yeah, gotcha.
Well, I mean, blow up one part of it.
Point is,
did this event cause the Europeans who've been placid, passively accepting? I guess we'll go to renewables. Does this fundamentally change them about their blind support of moving away from fossil fuels, and just change the whole ESG renewables narrative, where they go, crap, we can't invest for 50 years from now and starve everybody today.
So I think the issue is one. I don't think it changes that much. I mean, clearly they want to diversify away from the reliance on Russian oil and gas, and they want to find new sources of oil and gas. But I don't know that they want to start tearing down, windmills. And so I don't know that it changes it that much. But here's the issue: if I'm now an oil company, I look at this and I say, great, Europe still wants to wean itself off of fossil fuels. They need my stuff because they don't want to use Russian stuff. But 10 years from now, they may not need they may be off of that. They want to go to all EVs, so no diesel gas sales to the transportation sector. So how willing am I as an oil company to spend billions of dollars developing, field someplace to meet this new demand from Europe, but knowing that it may only be, by 2035, they may want to zero it out, right? So that's going to be the challenge. I think that I don't think they're going to give up on renewables, because they could look at this whole Russian thing and say, man, if we could have only been to 100% renewables now, right? We wouldn't be doing this right now.
That's right. It could have the exact opposite impact of what I think. But again, they have to deny physics and economics.
I understand
to
that.
Get to that point.
But the point is, I think it makes it a very difficult time if you're a big oil company, and I think they'd be very reluctant to chase that kind of opportunity aggressively. So,
just for the record, I'm a commodity. I'm an oil and gas super cycle guy, and I'm 1 year into a 10 to 20 year upcycle. Everything's going to be for sale that we own in 3 years. So we had a question
about
which
offshore
was,
services.
What about offshore services? And just for you drill a well offshore, you still need drilling, completion, production related stuff. Generally, what we have seen is the further offshore you get, or the further not North America you get, the more likely it is that the services that are certainly downhole are going to be provided by Schlumberger, Halliburton, Baker Hughes.
Sure.
That's what it is. But then there's also all the other stuff you got to have: things that float, things that fly, things that rent. And are you well? Our oil field market report is folding in our new forecast. And I don't know if you mentioned it in the podcast, because I've been reading questions. But if you look at our OMR, and you can look at it online, spiritualresearch.com, that this year, it was already a growth year, but now the growth year has the OMR up by, what is it, 20% or 30%?
I think it'll probably be 30% by the time
30%. And a big portion of that, half of that, is related to offshore and offshore services.
Well, part of it is those were down so much that anything looks like up from here. I think,
bet
right?
They were underwater.
Economically,
demand
for those again, the customers there are a large portion of that are big multinational firms, and they haven't abandoned the oil patch, but they've certainly cut out offshore exploration, except in selected areas. But it's stable. I think the number of new offshore field development projects that was going to be approved is going to be up substantially this year. I think it was going to be up substantially this year already. So yeah, I think
that was pre-war.
That was pre-war. Yeah. Now that queue doesn't change very much just because prices go to $110 a barrel.
Because nothing can be put in place by summer.
No.
It's summer 2 years from now.
Oh gosh, yeah, right. So yeah, but I think it's a sustainable increase that we're setting ourselves on offshore.
Yeah, the big thing that's going to happen is the service companies again are already at sort of maximum deployed utilization of whatever thing they've got or people they've got. And so to put one more thing out in the field comes at a materially higher price. So whoever buys or rents the next thing is going to pay a higher price than the guys that have had stuff under contract. And the things that are under contract, when they roll off, new higher price. So because there are constraints in the service sector, even at Schlumberger.
For both offshore and land international, last year we were, already hearing that service firms and operators both were concerned that the supply chain problems they were having then made them worried that they could hit the kind of timing of projects, on down the road, that it wasn't becoming a problem, it become an issue. I think that was the thing. It was like, it's a problem when we have to, scramble around it. It's an issue when the stuff's just not good. So that was already becoming a factor before, everything went fruit basket upset this past week. So, but I think the underlying trend in terms of rising activity and follow-on impact on pricing is going to be real.
So I think that's, that about wraps up all the questions that I was able to gather.
Good. Okay.
But, John, this is one of those times where our forecast is abruptly or dramatically different than it was.
Yes.
And we're doing the best we can on trying to imagine what that looks like. There is never a right answer. We're never perfect. I wish we could be. But to me, this is the best outlook. This is the best forecast we can craft at a time like this. We'll revisit it in early June.
Officially, we'll revisit it then. If things change dramatically between now and then, we'll probably issue some interim update. But
okay, we're going to end on the following thing. What price of oil do you think the peak is going to be?
The peak?
The peak. The one-day peak. All right, our producer of our show.
Above or below 150, right? Yeah.
Well, no, I want to give you a real number. The producer of our show, Charlie, he's at $200.
I think it's 125. It might happen.
It's going to be 125 this afternoon.
Yeah, but I don't think it's a long-term thing. I think the provenance, the questions around the provenance of Russian oil, and you get that tanker. Does that tanker, is it sanctioned? Is the oil being sanctioned? Is the guy selling the oil being sanctioned? How am I going to pay for it? How am I going to insure it? Those questions are pushing prices higher today. I think they do get themselves resolved, and probably sooner rather than later. So
I'm going to take the following. If there was such a thing as a steady state price of oil, I'd say it's $85 a barrel.
Okay.
And since we saw during COVID a negative 35, that's what's 35 plus 85. That's
150.
150. So
115,
115.
Yeah.
So I'm going to take $85, add 115 to it, and I'm at 200 with Charlie Spears, baby.
And I'm outnumbered. Okay.
You're outnumbered. All right. Thanks for listening.
We'll have to have a podcast to see who's right about that.
We have put this discussion of our forecast in the public domain. If you'd like to have the numbers and the full drilling forecast, go to spearsresearch.com and you can find the drilling and production outlook there.
Fantastic. Thanks for your time. We'll be in
you.